Somebody shuffling a lot of papers or
Yeah.
something.
Please go on mute. Okay. Okay, let's get started. So thanks everyone for joining today. So last time we talked about covered calls. So cash secured puts is the other way of making a regular income, right? So but here we are dealing with puts rather than calls. So please go on mute unless you are asking questions or answering my questions. Right. My first question to you is what is a call and what is a put? Anybody?
Call is buying the right
Call is
to buy.
you're looking going long, right?
Call is right to buy and put is right to sell.
Right. So that is from the buyer side. Buyer is also called either long or short. When you say you're long, are you buying or selling?
But you're buying.
Buying, right?
Buying.
So it can
Yes.
be a long call means you are buying a call option, a right to buy a stock at a particular price at or before a particular date, which is the expiration date, right? So when you say long, you are buying it, and similarly, long put gives you the right to sell a stock at a particular price on or before expiration date, right? So that is the long side of it. But today we are going to be talking about short side. What does short mean? So long means buy. What does short mean?
Hoping for the stock price to go down.
No, short means sell. So this is very simple definition, right? So when you say you are long, that means you are buying. It can be calls. When you are buying a call, when you are long on call, you are hoping that the market will go up. When you are long on puts, you are hoping the market will go down, right? But we are making money. Ours is not a growth strategy. Ours is an income strategy. So you want to produce a steady income out of the cash you have, right? So that's what is today's focus is. And this is short. Short means you are going to sell, right? So you are going to be selling puts, right? So that is the main thing. So cash secured puts means you have cash, you don't have any stock. You are making money with no stock here in this strategy, right? So you are saying that at this price, I am willing to buy this stock, right? At this price. That's what it means. And for that you get a premium. But at the same time, you do get the obligation. So you have to remember either on short calls or short puts, you have an obligation, right? So the buyer of the calls or puts has rights, and seller of calls and puts have obligations. So you are getting some money, but you have to you are obligated to buy that stock at a particular price. That's what it means. So again, I have the standard disclaimer here, right? So options trading is risky. You have to totally understand what the strategy is. So you have to do a lot of research. So I'm trying to save you time in doing a lot of research by giving you a good background of the different strategies. So we covered calls before. The video is available in our group. You can watch it anytime. And today is the put strategy, right? So these are all income strategy, but it doesn't guarantee you money. You can lose money if you make mistakes or you don't understand what exactly you are doing. And even if you know exactly what you're doing, there is a potential for losing some money, right? But we do give you tips to minimize any risk of losing. But still, options are not for everyone, but it's a good way to sort of advance your trading skills and investing skills to complement your stock investments, right? So you should not be having 100% of portfolio in options, right? So particularly on the long side, right? Because options keep on losing money. And so you have to do your research before investing, and definitely if you lose money, I don't want to be responsible, but do your own research and do your own investment. Okay, so we talked about what is a cash secured put, right? What is the objective here? To generate income in hopes that the option will expire worthless or build a stock position at a relative discount. Okay, so there are two ways here, two objectives here, right? So you are saying that you want to make some money, right? You have some cash and you want to make some money, right? Or you are interested in buying a stock, but you don't want to pay the full price, right? You don't want to pay the full price. You're hoping the stock will go down slightly so that you will buy it. And for that, you can get some cash also paid here. So basically, it says that the strategy is a two-leg strategy. Actually, it's a single-leg strategy because cash is sort of a neutral thing. So basically, you are selling put options, right? So when you are selling put options, you acquire an obligation to sell to buy that stock at a particular price, right? So we have some examples which will explain everything, right? What is the bias, right? So you are hoping that the stock will either move sideways or it will go up. You don't want the stock to go down drastically, right? If you think that the stock might go down drastically, you should not write a cash secured put, right? So selling is also called writing, right? So you should not sell or you should not write a put if you think that the stock is likely to drop precipitously, right? If it is going to slightly reduce, and if you want to buy the stock, then it is a good strategy, right? So, and here one problem with this strategy is that, let us say if you have 100K, right, in cash, right, and you write a put for 30K, right? So you write one contract selling at like like $300, right? So each stock, say for QQQ or something, is selling at 300. That means $30,000. You have to keep it away. You cannot do anything with that cash, right? So because you have an obligation, the broker will make sure that you don't reuse that cash for anything else. So that cash is sort of a locked thing. So even if some other opportunity comes, unless you close this position, you cannot sell, you cannot buy anything using that portion of the cash, right? So it basically locks up. When you're writing a put, it locks up because the broker wants to make sure that if the stock actually drops below that value, you have the cash to buy it, right? Unless you have to write margins and other things which we are not covering here, right? So you have to have a margin arrangement, and then you have to borrow from the broker, and you have to pay interest, and that is a bad strategy, right? So in GameStop, a lot of people, short sellers, made losses, right? Big losses. So because they shorted the puts without the cash, right? So we don't encourage that here. So that is called naked put. So naked put means you don't have cash. You think you are betting that GameStop is highly valued, right? So I'm going to sell a put, and so that way, when it goes down, I can buy it, and then I can sell it back, right? So at a higher price. So that is what they were hoping. But what these Robinhood traders did was they kept on buying the stock. Then the stock kept on going up, and when the stock keeps on going up, the broker, right, because you don't have the cash, they will keep on asking you for more money. Then you have to sell your other stocks which are in the money. So it's a real mess. So that's why people lost billions of dollars, because they wrote puts. They shorted. They were short on puts, but without the cash. We don't encourage that in this session, right? So here you are assuming you have cash and then you write. So that way you are always covered. You don't have to borrow, you don't have to go bankrupt, nothing. You have the cash and you are okay buying that stock at a particular price, then this is a good strategy, right? So that is why it's called cash secured put. Even though it is just one leg of writing a put, right? But it is called cash secured put because it forces you to have cash and not borrow or not take a risk. Naked put is highly risky, right? So any questions so far?
Yeah, one question is that you need to keep the money with you, or the money has to be with the trader.
Yeah, it has to be in the trader. So yeah, it has to be with the trader. Otherwise, how will he know whether you have
Yeah,
the
so
money
in
or
that case, you're not anyway. It is secured for as far he's concerned. He's secured.
yeah.
You cannot use the money for anything else.
No, that money, whatever you have written the put, you cannot use it for anything else. You cannot double dip on the same money. Then you will have a risk. They wouldn't allow it anyway in our level 1, level 2 trading. Okay, so good.
Good.
Nari, how
Yeah.
long are you putting? How long are you keeping? Is it for the duration of the options?
How? Yeah, right. So until the expiration date. Right, we will be discussing how to select the expiration date and all that in one particular strategy called Nanban strategy. But it is typically to until the expiration date you have to hold the cash. Okay.
Maybe you will cover later on, Nari. If you do something in between before the expiry date, you can do anything, or you have to.
You can do anything, like you can close it, right? So you can close your current short position by buying a put, and then that will close it out.
Okay.
So
Okay.
you are not committed, like in the sense that once you decide an expiration date and once you write a put, there are no other options. It's not like that. You always have an option, but you should be willing to lose some money or gain some money, close it out, right? So there are options to there is not option. I mean, I don't want to use the word option because it can be confusing. There are ways of closing it, right? But you have to. I mean, typically you wouldn't close it unless you want to achieve your objective, right?
Yeah, basically you can close the option before the expiry date.
Yeah,
if you want to.
You can. I will be covering that. Under one circumstance, you will cover that. So if you are going to be the option is going to be exercised and you don't want to buy the stock, you can close it out. You might have to pay more to buy it out. So you will end up with a slight loss, but you can close it out.
So, Nari, your dominant thought when you're getting into this quadrant, that is short put, your dominant thought is you want to buy, or you want to just look at the options and get some cash out of it? Which is your dominant thought?
Yeah, both are possible. Not necessarily you have to buy, right? So it can be just an income producing strategy. You want to keep your cash. You don't want to typically necessarily buy, but you are okay buying, right? Only then you will. It is.
I mean, sometimes it is the way I want to buy is how I mean, this is the method by which I want to buy anyway, right?
Yeah, correct. So that is how it helps you, right? To buy a stock at a cheaper price. This is what I posted, right? So it allows you to buy a stock at a cheaper price than the current market price.
Got you. Okay.
But if things are working out, so one risk with this strategy is if the stock keeps on going up, right? So you will write a put, and you will not get the stock, and you can keep the premium. You can keep on getting the premium if you are writing the put, but if it keeps on going up, you are not going to get the stock. So there is no guarantee that 100% you will get that stock.
Right.
Yeah.
Those are the times when you want to close and go after it again, is it?
Yeah,
If you really want to acquire the asset. Okay.
Correct.
Okay.
So that is what I'm saying. It's slightly harder to understand, but once you do some trades, then That is why TD Ameritrade has the paper money and all those things, right? So
Yes, yes. Okay.
okay, let us take an example, right? So you want to own, so in this case, they actually want to buy the stock, right? So they want to buy 100 shares of XYZ stock. It's currently trading at 100, right? And you choose the current month's 98 strike put option, and then for that privilege, you get a premium of $2. So that means you're collecting 200 straight away, right? And you are setting aside 9800 in case of assignment. How did we get 9800?
Because you got the 200 in the premium, you only need to spend 9800 when you're buying. Is that making sense?
No, actually it is 98 is the strike price.
Oh,
And
yeah.
in this case, the example is messed up. It's $2 and 200.
That's okay. Yeah, no, I got it.
See,
I got
the
it.
difference between 100 and 98 is $2, and premium is also $2. That is not necessarily the case, right?
Correct. 98 multiplied by 100 is
Actually,
9800.
the
Okay.
9800 is because the strike price is 98 and one contract has 100 shares. So you set aside 9800. Okay.
Got it. Okay.
So slightly tricky here. Right.
This
So
is a good test.
so put strike price is 98 and premium is 2. Right. So those are the terminology. Right. Let us look at the risk profile. So let us try to understand with this graph, what is the maximum gain? Can anybody say what is the max in the previous example, right? What is the maximum gain you will get?
200.
Okay. How?
That is the collected premium that you have. So
Right.
that's all you're going to get.
Yeah, exactly. Right. So Satya, that's good. Max gain is premium received from selling the put. So that is the only maximum you are going to get. If the stock keeps going up, you are not going to get anything, right? If the stock keeps going down, then there are potential losses. But maximum gain, assuming that the stock has sort of not reached 98, then you just decide to keep the premium and nothing. You don't get the stock, right? But you do get the premium. That is the max gain strategy. Max gain possible. And maximum loss. Okay, what is the maximum loss possible?
The stock goes to zero, so you lose
It's only a person.
10,000. 10,000 less 200, 9,800.
9,600.
9600.
How is it 9600?
Because
you have to
9800
pay
is your commitment.
9,800 and
Suppose
you,
price goes down to
yeah,
zero.
yeah. If the stock goes to
So
zero,
losses in underlying if assigned and stock falls to zero, right? So
Yes.
yeah, that's what it is. And what is the break-even point? Break-even point is the 96, right? So
Yes.
break-even point is 98 strike price, and if it drops by 2 and it becomes you already got 200, so that is the break-even point, 96.
So Nari, this particular indicates very clearly that you use this cash secured either for buying the put itself. That means buying the stock itself. You want to use it for good purpose.
Yeah. So whatever
That's
money
the
you have
reason.
reserved, whatever money
Yeah.
you have reserved, it will be used for, it will be automatically exercised when the buyer of the put option exercises it. Then you have to sell the stock. You have to buy the stock. Yeah.
Or you are happy with the $200 maximum gain.
Sorry, what?
See, either you are interested in buying the stock, then you
Yeah.
put this,
Or you want to get some money, right? That is the strategy here.
or just a small money of 200 in your $10,000.
Yeah. But it can be within a week or something, right? So it's, if you keep on repeating
not-
that, you make money, right? That is
Yeah.
Nanban strategy.
Yeah, that's good. Yeah, good. Thank you.
Nari, I have a question.
Yeah.
So the stock is dropping from 100 to 98 to 95
Yeah. So
And
these scenarios will be covered. Why don't you hold the question here?
sure, okay.
Okay. So I have the
Sorry, I also
scenarios.
have a question.
Yeah. Yeah.
Can you hear me?
Yeah.
Okay. This one doesn't consider the opportunity cost of the funds locked up, right? $30,000 been locked up till the, let's say, the exercise date.
Right.
So that means you could have been using the funds for other purposes.
Yeah.
And this strategy does not consider, it's purely that particular transaction is all that this strategy is concerned about.
Yeah. Yeah.
Okay,
I
thanks.
mean, these days, if you are comparing against treasuries or something, that is peanuts anyway, right? Like
Okay.
opportunity cost. These days, interest rates are very low anyway.
Now, what I meant by opportunity cost is if there is an opportunity, like you said earlier,
Yeah.
the
Right.
funds are locked up, but if you feel, you can say there is some other security available which you could be going after,
Right.
but the funds will not be available for that.
Correct. Correct.
And the funds that are with the broker, as the funds locked up, I don't think they pay any interest on the funds they have.
They
Right?
they pay very less, 0.01% or something.
Or something like not even worth talking about.
Right.
Okay.
Right.
Okay. Thanks, Nari.
Thanks, Govind.
On
So
terminology, I
Nari,
want to
this,
understand, Nari. You mentioned closing, right? So what does it mean exactly in this scenario? Like if before the date, or what is it, strike price, that date, you have a date, right? Before
Right.
that,
Right.
when you
For
say
some
closing, what
reason,
does it mean?
you don't want to be obligated anymore,
Uh-huh.
right? So because you are short on put, you have to buy a put, equivalent put, that will cancel it out. That is,
Okay, which means have you spent the $200 that you made?
you might have to pay even more.
Or you spent?
You might have to pay
Okay.
more. You have to
Got
pay
it.
the current price. So you may end up in a loss also if you want to close it beforehand.
Basically, you're nullifying the obligation to buy that
Yeah, you are
by paying
nullifying
whatever
the
price.
obligation, so it may be positive, may be negative, maybe break even. Right?
Okay, got it. Thank you.
Depends on the prevailing stock price at the time you make the decision to close the order.
Got it, Nari. Thank you. Okay.
Yeah, the person earlier who said whether you have opportunity, I'm saying that if you have a good opportunity, you might take a loss and proceed with the other money somewhere else. You can close the put and go ahead.
Right. Yeah. No, that's a good point. Yeah. I mean, that's why I said it is not like a locked forever, right? Until typically you don't want to be keeping on changing your mind, but it does allow you to change your mind, but maybe at a cost.
Got it. Okay.
Okay. So there are 3 scenarios here, right? So let us look at each of these scenarios. If you remember the previous example, so the stock is currently 100, right? So you wrote a put for 98 and you got a premium of 2, right? That is, just remember that. Let us say the stock closes at 103, right? So the stock has gone up, see, 103. So your option is OTM. What is OTM?
Over the money.
What?
Out of the
money.
Over the money.
Right?
Out of the money.
Out of the money.
Out of the money. Yeah, exactly. Right. So that means your option that you have sold becomes worthless, right? So at the expiration, it is 0, right? So then the buyer of the option, as far as he bought, it is worthless for him, right? It is worth for you because you got the premium. When it says it expires worthless, it is for the other leg, right? So it is for the buyer of the option.
Okay.
But you miss the chance to buy the stock, right? So you wanted to buy at 98, but it has gone to 103. So you cannot, you miss the chance.
Okay.
You do keep the premium, 200 premium received less transaction cost, which is like 35 cents or something like that. Right?
Yeah.
So that's what it is. Any questions on this? This is clear, right? So in this scenario, stock goes
Very
up.
clear, Nari. But if you wanted to buy the stock, if you bought at 100, when instead of setting up this option, you will be having 300 more than the 200.
Yes. Yep. But it could have gone down also. You don't know, right? So That you can always do. Yeah,
Absolutely.
you're right. That is why I'm saying this is not like a strategy you do 100% of your portfolio, right? So this is just some small percentage of your portfolio. You do this to generate some income, right? And also in our strategy, which we are going to cover, right? It is all on standard ETFs. So this strategy can be used for like stocks also. I did try some things like that. I was exercised. I was able to get the stock at a cheaper price, and some other things, some other times when I tried the strategy, I just kept the premium because the stock went up anyway slightly, right? So it all happens, right? It all depends on the market, right? If that is why the strategy makes more sense in like a stable market, or not like a heavy growth market where you want to buy stock. It may be better to buy a stock and get the full appreciation. Here you have the chance of missing the stock, missing the chance to buy the stock, right? So that thing is
Harry,
there. Yeah.
another question. Is this where the Tesla shorters were losing all the money? That they were assuming that the stock was going down and went up? Something like that or not?
Yes, so as I explained, they lost money in two ways, right? So one is the stock kept going up, and then because they were borrowing the cash, so they basically. Are you talking about short options or short stock? Because they are different.
Oh, I thought we were talking about short options, but
Yeah,
I don't.
right. Yeah, short option. Yeah, they can also lose money in the margin calls. So that is what that is why, like in GameStop, right? Short squeeze can occur, right? If you don't have cash, then you have to keep on. You have to buy it at the open market.
One more question, Nari. Of course, the example you're given where $2 and $100, is that the realistic numbers, or because that makes sometimes saying if you on $10,000 making $200 looks good in a week, but if the numbers are no for the $98 in this case, the premium you're getting is only 0.5, then is
So
only
it really depends on several factors. It's a very good question, right? It depends on what that stock is, what is its volatility, right? So TD Ameritrade, if you look at the volatility, right, and if there is a higher volatility, you will get a higher premium,
correct.
right? So you will get a higher premium. It depends on the expiration date. So in SPY, which is a pretty stable ETF, you will get the premiums are around like 15 to 20% of yeah.
Okay, that's what I thought. I was looking to SPY only.
Right. Yeah. But you can buy this. You can use this strategy on any ETF or any stock for that matter.
Mhm.
Okay.
Thank you.
So the next scenario is stock goes down a little bit, right? So we wrote the put at 98, but can you go on mute? Whoever is making some sound. Let's say the stock closes at 97.95 at expiration. So that means your option is ITM. What does ITM mean?
The money
In the money.
In the money.
What does in the money mean?
means it hit the strike
You are
price.
Yeah, it's right. So for the option, the buyer of the put option, right, they can start making money on that. So you will be assigned to buy the shares for $9,800, right? So that is when you buy the stock. Actually, you purchase shares at a relative discount. Relative discount compared to, let us say 100 it was, right? Instead of paying 10,000, you are paying only 9,800. But
minus the 200 you made. Right? You made 200 also, so it's actually effectively 9,600 you're spending.
Yeah, you already have the 200, right?
Yeah.
So
Yeah.
that means your break even is 96. So you are
Yeah.
still making money, right? So even if it is 97, 95,
Right.
right? So you are still making money because your break even was 96, right?
Correct.
So here, but you do pay higher than the market price. So market price is 97, 95, but
Right.
you are paying 98, right?
Agreed. Yeah.
$5.
But in this case, you are still making money because you already got $2 premium, and you are only paying 5 cents, right? So you are still making money overall.
And
But
you have to buy now. You have no choice.
you don't have any choice, because that is what is meant by writing the option. That is what is meant by obligation. Obligation means you cannot escape unless you close that option before the expiration date. And let us say this scenario, right? Stock goes down a lot, right? So let us say the stock falls from 100 to 90 prior to our expiration. Then your option is in the money, right? That means for the buyer of the option, so you will be assigned, not just likely, you will be assigned to buy the shares, right? And the premium would offset some of the cost, so up to 96, but you will lose like $6 per, so $600 you will lose, right? Because it is, the stock is worth only 90, but you are paying 98, right? But you have got $2 premium, so 96, so $6 you will be losing. So the stock has gone down from 100 to 90. So because you are obligated, you have to buy the stock. That is why we have some strategies later on to have some insurance to protect yourself if it goes down drastically.
So one question here.
Sorry.
One question. Yeah, one question here. So obviously, it in a bad situation, it can have a real drop. But in reality, in real life, it may go for 99, 98, 97. And if you feel at any time that it might, now you're in danger, you can come out of this option contract.
Yeah, you can close your option at
That
any
is the
time.
closing is, that's what is closing, right?
Yeah, you can close the option anytime, but there will be a cost. We already discussed that, right? So,
But yeah, okay.
somebody had a question on the scenarios. Anybody, is this clear?
I mean, so would you consider it being in your favor if it is the top two, that is the blue and the green options, or
Definitely.
I know there is a bigger picture to the whole thing, but looking at it locally,
definitely. This is not a good scenario for you, right? Because the stock has gone down a lot, but you are forced to buy. You are basically losing money.
Got it. Yeah.
You are losing money in this red scenario, right?
Yeah.
That is why I put red. I chose the colors wisely.
Okay.
Hey, Nari, but going back to what we discussed in the blue one, if you bought the stocks initially at 100, you will be losing like the $1,000. In this case,
$1,000,
you are
right?
just losing 600.
Yeah. No, because you got some premium, yeah. No, and also it is at a lower price, yeah. That is advantage, right? So you answered your own scenario, Jorge. Yep. Any other questions?
Nari, can you explain that? Sorry.
So what Jorge is saying is, he was saying before that if the stock had gone up on 100, 103, right? So if you had, instead of selling a put, if you just bought the stock at 100, you would have made 103 minus 100, $300, right? So instead of making $200, you would have made $300. That's what he was saying. But in this scenario, right, instead of losing $600, you will be losing $1,000, because 100 to 90 is $10 difference.
Got
right?
it.
Times 100.
Yeah. Okay.
Yeah, this is the bad scenario for writing a put, right? This is the worst scenario. That is why you can buy some insurance to limit your losses. So by buying another put at a cheaper price, we will explain that. Any other questions?
Yeah, so
Hey,
Nari,
Nari,
in the scenario 3, right? Let's say the stock is dropping and it's at say 95, right?
Mm-hmm.
And then you say that, you know what, I feel it's going to drop more. So the only way to close it before the expiration date is to buy the reverse, buy the put and
Buy the
close it
put,
out,
yeah.
right?
Buy the
Right?
put, which will be more, which will be
Yeah, but
more
then you'll
right
pay
now.
like about same $1 or $2, but at least then you are limiting your
Yeah,
loss and closing the
correct.
transaction, right?
Yeah,
That's the only way to close it before the expiration is to do
correct.
the reverse
And
transaction,
if
right?
you are short put, you have to long put, right? So
Yep.
you have to buy
Yep.
a put.
Yes.
so just the one thing, Nari, this Vishal, what's the tax sort of implication of this? Is it so the premium that you make? How does that count towards? Is it like a short-term capital gain, or what
All
exactly
short
is
term,
it?
I think. Short.
It's not a capital gain. It is an income, right? So
Okay. So,
yeah, so it's a good question. So I normally trade all these things in my IRA account. So there is
Yeah.
no tax impact. But I don't want to say something wrong. But I don't think it is capital gain because you are not selling an asset, right?
yeah, it's
Right.
like interest income then.
But you have got
Yeah.
income, so you might have to pay at your normal income tax rate.
Yeah.
I will check on that.
Thank you.
Hey, Nari, you have your IRA in Ameritrade in TD?
Yeah.
Okay.
Yeah.
Nari, I have a question.
You have to apply for privilege for trading in options in IRA account. Yeah.
Nari, I have a question. So when the stock price is dropping to 95 in this particular case, when are you obligated to actually buy it? So the brokerage actually forces you to buy, or do they send something, or what happens?
So yeah, so typically if the buyer of the option exercises it, right? Only then broker is not going to force you. The buyer has to sell the stocks to you.
The buyer has the right to sell
Yeah,
it at
right.
98.
Nari,
They
is
have
it
the
tied?
And
Is it
when
tied
the
like
stop
one-on-one
is
like
at
that?
95.
Sorry.
Sorry.
No, I'm asking, is it tied one-on-one like that? I thought it's a market thing, right? It's a pool, correct?
And yeah, so most likely you will have to buy the stock. So that is how it'll normally work. So it is
I
not.
know I have to buy the stock, but as the market is fluctuating, somebody has to make a call and say that, okay, I want you to buy the stock right
Correct.
now, right?
Yeah.
So when you
So
say
who
You
makes
make it
that call? Is that the
I
brokerage
think
does?
usually it's made by the market maker.
right.
See, there is always a market maker in between a buyer and seller in these kind of options, because at the time you want to sell an option or buy an option, there may not be a buyer on the other end. So there is usually a market maker in the middle who is buying or selling from you, and then 1 millisecond later or 1 minute later he does the opposite with somebody else. So
Right.
he knows that another guy is coming. So it is the market maker who will force the issue, because you are now obligated to buy, and the stock is selling at buy it at say $100. The stock is selling at $99. There is a $1 to be made. The market maker will come and make you buy it at $100 and take the stock, and then immediately sell it to you at $100, and then he will hold that negative stock position for a minute or microseconds, and then make the $1 difference. So the market maker will make that money.
Right.
Oh, I know he does, but at this point you are holding this position, and then you have the money available to buy that. So will the brokerage automatically just make you buy it and then do the transfer automatically,
Yeah.
or do
Yeah.
they send you an email
Yeah. It's all automatic because
this all the
you have
time?
the cash reserved, right? You have the
Right. So
cash
they use
reserved.
that
That is
cash to
why.
buy.
So the stock will the next day the stock will appear in your account.
That's all. Okay.
Yeah.
So they automatically do it.
It usually happens, but there are a few times I have noticed where the market maker or the broker doesn't get it. So if you're off by just a few pennies here and there, sometimes you can just escape it. I have escaped like that a few times, where at 3:59, the last minute, the transaction doesn't go through for somebody, and you can make like 20 cents. You will essentially make 20. If let's say you want to buy, you are obligated to buy at 100, it is selling at 99.80 or 20 cents, 10 cents difference is going on. At that time, you can sometimes escape.
Yeah, but it's I think it's pretty rare.
It's pretty rare, yeah.
Okay, no, this is a good discussions on this slide. Any other questions?
Ari, when you're doing in your IRA, then like let's say if you have the $10,000 trade, you need that money in that money market account, right? You would have
Yeah.
to sell one of your positions to have that cash available, right?
Yep.
Yeah.
Yeah, you should have cash. Okay, so you can select ETFs, or how do you if you want to buy some stocks, right? So consider equities that exhibit fundamental value, right? So you don't want to buy GameStop and other like stocks in this, right? So that is a losing strategy because the volatility is too high. First of all, you can't predict what you're doing, right? But this is a golden point, right? Consider equities you are willing to own at the strike price. So I am very comfortable to buy this stock at this price. Then you can write a put on that, right? So that way you're totally you're a winner either way, right? So you are getting a cash, you are getting a premium, and you are willing to buy that stock at that price, right? So you select stocks like that. And what they are saying is for options, for liquidity, consider low bid-ask spreads, right? So you don't want to buy some stock where there is a like a huge variance or low interest or low volume and stuff, right? So it may not happen. That's what they are saying here.
Mary, question: who decides on the premium?
Who decides on the premium? It is a balance between like buying and selling. So different millions of people want to buy it at a particular price, right? So it is based. It's established by the market based on supply and demand, and bid and ask prices. So somebody is like a buyer is offering such price and seller is offering such price, and then they meet somehow. That is how the price is determined. But there are some Black-Scholes formula and all that for options premium calculations, right? They do the bid and ask are based on the Black-Scholes formula, which determines the option premium. It is a very complicated formula. I learned in corporate finance in my MBA, but I don't remember it now. But
So
that is how the price is determined, but ultimately it is a supply and demand situation. It has so many different factors. It has factors on like what is the expiration date, what is the strike price, right, and what is the volatility, right? All those factors are calculated in calculating the premium.
Nari have found one simple way of calculating, but maybe not 100% correct, is the current price and the forecasted price. So they normally, if current price is 100 and forecasted price is 95.
What do you mean by forecasted price? Strike
on that day, because you have options available for different days. Okay.
No, what do you mean by let us use the proper terminology. Are you talking about strike price?
Yeah, correct. Strike price. So if you want to buy a particular strike price, you typically have to pay today the premium which is equal to the current price and the strike price difference, assuming that is how the likelihood of that strike price on that day.
That may be true in like in the money options for a very few very tight range, but it is definitely not true for all the different expiration dates and different ranges, and so
Okay.
on, because the formula is much more complicated than what
I'm sure. Yeah.
yeah.
Whatever I've seen, I'll try to analyze it now.
Yeah, sure.
The
Yeah,
the
we are
time
always
scale,
willing to learn.
Nari, the time scale granularity is a day, is it? It's not like by hours and minutes, right? It's a day, correct?
It is
So,
days. It is maybe
so
you see
we
normally
covered in the options class, right? Expiration date. So
yeah.
typically most stocks have one expiration date per month, right? Which is
Yeah.
the Friday, I think second or third Friday of the month, or third Friday of the month, right? That is the only date the expiration date will be there. But for high frequency or high volume trading, such as index funds and so on, there will be weekly options also available which expire each Friday. And for SPY, actually options are available for every 2 or 3 days, right?
So
So
in that grid in Think or Swim, the cells movement is like weekly, daily, or not daily, sorry, monthly or weekly, basically. Okay.
No, but the premium amount is constantly changing. So, for
correct.
example, if you go at 10 o'clock, if you
Oh,
get,
yeah, okay.
yeah, so the 11 o'clock, no, the
Yeah,
premium amount is going to be
correct.
different. So
That's
Got
why
it.
I'm
it's a
saying it's
constantly
supply
moving
and
thing.
demand and whether the stock has gone up already, right? So
Okay.
because between 10 and 11, the stock price might change, right? So when the underlying stock price changes, all the option prices keep changing.
Will get adjusted. Okay, got it.
Yeah, they keep changing throughout the day. Oh, if that is your question, yes, they change from minute to minute, or second to second even.
Got it. Okay, thanks.
Right.
They
So
And
change,
Hari,
yeah,
they change because of the current price change.
yeah. When the current selling price, current market price changes, option prices will immediately change.
Correct. Correct.
Yep.
Nari, question is if I just understand this right, is your option strategy aligned with your long-term strategy? Like in other words, are you trying to buy the same options that you have in your portfolio?
No, this has nothing to do with what you have in your stocks, because this is you can do that for any stock that you don't have, because you are willing to buy stock also, right? You may have that stock, that is a different thing, right? This is totally independent of what you have in your current portfolio.
Well, so in order to fund this, you are pulling dollars from your portfolio, right?
Yeah,
So you
you
want
have to
to
have either
basically,
cash, or you have to sell some stock and keep some cash.
Yes, yeah.
so your objective is to either do better than your stocks, or else why
So
would you pull money from your portfolio?
yeah, nobody is 100% invested, right? So I mean, I hope not. Because I mean, you'll always have some cash, because if the market goes down, you want to have some cash ready available so that you can buy it at a cheaper price, right? So you can use that money, and then you can do that, but at the same time it is locked for the until the expiration date. So I'm not saying this is the only strategy, right? There are thousands of option strategy. This is one of the income generating strategy, which where you are okay to hold by the stock. Does it
Okay.
answer your question, or I'm not understanding your
Yeah,
question?
no, I guess I think somebody already asked that question before as well. Like, it's the opportunity cost, right? If I need to
Right,
fund
right.
this
Yeah,
from an
this
existing,
strategy may not be suitable for all investors of all persuasions and all risk profiles, right? So this has got, you can limit the risk here, right? And you can make some money on a regular basis, right? It can if it really works out, it can even get 30-40% a year return, but you have to be lucky, and you have to know what you're doing.
One question which is probably going back to the very basic thing. We are discussing about what is called as cash secured puts, where actually we are doing a buying of stock. So I'm slightly confused on the why we call it cash secured puts, not cash secured call.
No, you are selling an option, right? You are writing an option. That is a put.
Okay.
You are not buying an option. You may end up buying a stock, right? But you are, as far as the option is concerned, you are selling or you are writing. Is that clear?
Okay.
Yeah,
Option.
that's why I'm saying it requires a lot of time of actual trading before you are totally clear about the concepts.
Okay.
So one here they have given like expiration selection, right? Don't write a put for too long a period, right? Because you don't know what is going to happen. The stock might totally crash and you are committed to it and you have to keep the stock for a long time, right? So do it maximum of 30 days or less, right? So that is one recommendation here. What is time decay? Can anybody explain what is time decay and what is time value and intrinsic value?
So time decay means if the premium is $2 now, after like 3 weeks, that might be worth like pennies, whatever.
Yeah, exactly, right? So each option is price has two factors. One is the time factor and another is the intrinsic value, right? Time value and intrinsic value. Time value keeps on declining, and because you are a seller of the option, you are a writer of the option, time decay works in your favor, right? So when you are buying an option, time decay works against you because every day the option price keeps on going down, unlike stock, right? Whereas if you have sold or written a put option, then during the course of 30 days, right, that it will keep on decaying. So one strategy you can do, like after it declined say 50-60% or 70% or 80% or whatever, okay, you say that I don't want to, I don't want this obligation, I want the money to buy either stock or repeat the strategy, right? Then you can buy a put and close the position. Close the position by buying a put, right? So the time decay works in your favor, right? And
so that's kind of a direct formula, is it, Nari? Like, if it goes down by 60%, just close it, kind of thing, is it?
yeah, you can set up closing orders like that. Actually, that is part of Nanban strategy.
Right, okay.
Nanban strategy says that when you have made like 90% of the unless you want the stock or something, right? You can close it.
Got it. Okay.
So strike selection, it says delta between 0.3 and 0.4 balances probability of success and return, right? So if it is a very high probability then of delta, sorry, if it is a very high delta, who can answer except Bala and experts? What is delta?
Difference between the ask price and the bid price?
No.
It is that rate of changing, right? I mean, it's like the slope, the rate of change. Is that making sense?
Rate of change of what?
Is that of the stock price over time or the premium over time?
Bala spent 1 hour teaching us Greeks. What is delta? Anybody else? So delta means if the underlying stock changes by $1, how much will the option change by? Right? So if it changes by 30 cents, then delta is 0.3, right? So that's what it means.
So rate of change of the premium due to the rate of change of price.
Yeah, change of premium compared to change of price. Yeah.
Stock price. Yeah.
Okay. So exit considerations, right? So if option is in the money within 4 days of the expiration, then you have two choices here. You do want the stock, so then consider accepting the assignment, or consider rolling the option to the next month, right? So because you can make some more money when and buy it later, right? So you have the option, right? So you have the again, I don't want to use the word option. You have the privilege of immediately buying the
Choice.
stock or rolling the option to the next month, right? Those are some of the strategies. And if it is going to expire out of the money, right, you won't get the stock, right? You won't get the stock because the stock is still higher than what you are willing to pay, right? So it will just expire worthless. So the decision is very straightforward here, but here you have to make a decision whether you want to buy the stock or you consider rolling up the option to next month, make some more money.
When you
So
say
you-
rolling, you're talking about closing and then buying again, or what's the?
There is a roll option also. The
Oh, okay.
roll,
Yeah.
which basically it is a two-legged strategy. Basically closing the current option and buying a new option, but it will be executed by one transaction. You can just say roll, then it will prompt you.
Got it. Okay.
So the question here is, Nari, so you took 4 days because the fifth day it was expiring. Is that correct?
So what here in this example they are assuming monthly options, right? And they are saying that at the last week the option time decay is very tremendous, right? So at that time you take a decision. So because you don't want to wait until the last minute because anything can happen. So that is what they are saying, but it's totally it's totally your call. It's optional.
So how did you select 4 days?
That is the thing they gave whoever made this presentation. This is not my presentation. So
Okay.
they have said because you don't want to keep it for too long, right? So you already made some money, right? You already made some money, right? Then you just decide whether you want to buy the stock or just keep on rolling it out, right? So you might get a higher premium next month.
So when you roll out,
Is it
you
fair
don't
to
have to do
say?
more money transaction. There's
Sorry?
no more money transaction when you roll out.
Yeah, here you might have to you have to buy back the option, right? When you're rolling it out, you have to buy back the option because it is in the money. It might cost you more, but at the same time you will be selling a new option, you will get more, right? So it'll work
So,
out both ways.
so is it fair to say, Nari? Like I think when you create an option, for example, Monday, and if your option is going to be a weekly option that's going to expire Friday,
This is not for weekly option at all. This is only for monthly
The whole
option.
thing is
monthly
monthly.
option, okay.
Yeah,
The
I
4 days by
think
a month.
you're right. So that is why I did not spend too much time on the 4 days because that is what they are saying. But like
Yeah.
Nanban
Okay.
strategy is based on a weekly strategy, so that is not going to work. We have to decide on the last day.
Right. This is about 1/6 of the total time. Yeah. Okay.
Okay, so you had some risks there, right? So you had some risk of losing money, right? To protect against a huge down move. That is when we had the red scenario, right? Red scenario, it went to 90, right? So which results in a substantial loss. As you are obligated to buy the stock at the strike price, consider buying an OTM out of the money put at a lower price than the strike price. Okay, so this is an example. This will make it clearer. So if you are selling a cash secured put for 100 in the example, then buy a put for say 93 using the same expiration date. So that means even if the stock goes to 90, your loss will be only, like, you already got 96, so it will be only $3, right? So you have to buy the stock at 98, and even though the current market price is 93, because even if it goes to 90, because you have got a long put at 93, it provides you some protection. So you can sell it at 93. So even though the market price is 90, right? So you can sell, you can buy it at 98 and you can sell it at 93. So you are restricting your loss to $5 here. And it's compensated with premium, so it's only $3 loss.
Hey, Nari, did you have to pay a premium for the put that you bought?
Yes, you have to.
So there
It will
you will
reduce your
have
income,
another.
right? So it will reduce, it will go against your $200 revenue, right? So when you're, see, whenever you are
Right.
buying insurance, right, it's a cost, right? You don't make money buying insurance. It is a cost to you. It is a cost of trading. It's a cost of limiting your risk.
It prevents a bigger loss, basically.
Yeah, it prevents a potential for a bigger loss.
Yeah.
So, for example,
Nari, how do you know which order it goes? Because the direction of fall is that direction, so you automatically it will be a sequential thing, right?
so that is why this is a mechanical strategy, right? See, GK Nanban strategy
So it's a lower amount. Okay.
says that you sell a put and use 20% of your income. So that means you got $200. You take like $40 and buy a OTM put. So that will give you some protection in case March 2020 happens, right? If the stock drops a lot, right, you are still committed, you are holding a commitment to buy a stock at a much higher price, right? So in that scenario, right, it'll help you. If there is a huge market correction or just that stock collapses, right, so this will help you. That is why they are saying that use 20% of your cash secured put income to buy a OTM put. I think I have used this strategy many times, and I think this is a good recommendation. It is not too low, right? Your losses are pretty limited. So I calculated around 5% loss. So if the stock really drops like 10%, right, it gives you a 5% with our current prices and all that. I did some calculations and I worked out on a weekly thing. Like if you use GK Nanban strategy level 2, then it gives you maximum, it restricts your loss to maximum of 5%.
Yeah. Got it.
Okay, so another possible, this is not really an insurance, but this is more of an opportunity. So to answer Govind's question, Govind had a question: what happens if the stock keeps on going up? You have lost opportunity to have bought. Jorge also, I think, said the same thing, right? So this provides you some opportunity for here to take advantage of a huge up move. The stock keeps going up. Consider purchasing an out of the money call, right? So using a percentage of your cash secured put revenue. For example, if you are selling a cash secured put for 100 strike price in the example, then buy a call for say 120 using the same expiration date, right? So how do you determine this 120? That is why GK Nanban strategy suggests using 10% of your cash secured put income to buy a OTM call. So this is also an outgoing thing for you, right? So it is like 10% means you use $20 of what you have and buy a OTM call, right? It gives you some upside, right? So most likely you will lose this money, right? Whatever you're buying in this OTM call, you're likely to lose it, but it does give you some chance. Suppose if the stock just doubles, right? Then please go on mute. If Jorge, I think, can you go on mute? So using 10% of your cash secured put income to buy a OTM call. right? So that is the approach here. Actually, we do have some slide on GK Nanban strategy. We can go into the next slide. Okay, so I think hope those of you who attended covered call, we did talk about Nanban level 1 strategy, low VIX and high VIX scenarios. What is VIX? Anybody?
Volatility index.
Right. Volatility index, when particularly VIX stands for volatility index for SPY, right? SPY's volatility index is VIX. And for volatility index for QQQ, which is Nasdaq 100, is VXN. And for a volatility index for IWM, which is the Russell 2000 index, which is the small cap index, and that is RXN, right? So there are different volatility indexes for associated with the different ETFs. So in this case, they are using SPY. That is why they are saying VIX, right? So low VIX means if it is less than 20, right? So currently today the VIX is actually 17 and a half or something. I think it's 18. For some reason, even though market went up, the VIX also went up from 17 to 18, right? So that is considered a low VIX as per the level 2 strategy. So if the VIX is more than 20, it is high VIX. If the VIX is low, then it is if it is less than 20, then it is low, right? So what they are saying is, if it is low VIX, then you do a monthly transaction. If it is a high VIX, you do a weekly transaction. So that is the overall strategy. And also in low VIX, choose monthly contracts, right? So that's what I said. And select the premiums based on 1.5% of the current market price. So let us say if the current SPY is 400, right? 1.5% is $6, right? So that'll give you like 18% less insurance and opportunity and all that, right? So at a minimum, right? So they are saying that if it is a low VIX, in this strategy you basically make less money in low VIX than high VIX. High VIX because you can keep on transacting on a weekly basis, right? You are likely to get slightly more revenue in high VIX. And also generally speaking, options, when you are writing an option, when the higher the volatility, you make more money, right? So in Nanban strategy, they are talking about 3 ETFs, right? So generally, SPY for S&P 500, QQQ is for Nasdaq 100, and IWM, which is the Russell 2000, right? So those three, if you look at the volatility index, it's always QQQ volatility index will be higher than SPY, and IWM volatility will be even higher than QQQ, right? So the higher the volatility, when you're writing option, generally speaking, you make more money, right? Because you are collecting more premiums. But at the same time, the risk is also higher, right? So of going up, the stock going up drastically or going down drastically, right? Higher volatility means both ways. But generally speaking, you make more money collecting premiums, more returns using higher volatility indexes. So yeah, but because they want to standardize, they want to make the process mechanical, they highly emphasize SPY, but they are open to us dealing with QQQ or IWM. Okay, so here the whole presentation we have talked about selling a put, right? Selling a put to collect premium. So basically our strategy is step 1. Whatever we have discussed, cash secured put, right? You sell a put to collect premium. And then step 2, buy a put, which is, what is that? What is that for? Why are you buying a put here?
Downward protection.
Yeah, insurance, right? Insurance.
Yeah.
Yeah. So that is, they are calling insurance. So buying a put by spending 20% of X dollars that you collected above, and choose the strike price that is available at 20% of the X dollars. So if you're looking at the option chain, go down the chain, and if the, let us say that the premium you collected is say $4, right? So 20% will be 80 cents. So you go down the chain, look for 80 cents wherever it is, and buy a put, whatever it is. So they want totally mechanical. They are even developing a robot for this, right? So they want to make it totally mechanical, even though it is not like 100% mechanical. There is some decision to be made, but they don't want you to think. They just want you to execute this strategy, right? I think by and large the strategy makes sense. And step 3, closing orders. Closing order for step 1 by spending 10% of X dollars. So can anybody explain this? What does this mean? Closing order for step 1 by spending 10% of X dollars. Let us say in that example, right? So you got $200. You don't have to wait until the last day, right? So the stock keeps going up, right? So it's not likely to you will get the stock. So you just want to collect the money and move on, right? So it has already dropped. So from $2, it has dropped to 20 cents. So which is the 10%, right? You collected $2 premium, 10% is 20 cents. So you are saying enough is enough. I made my $1.80. So I made $180. I'm not greedy. That is good enough for me. So I just want to move on, right? So then I can just put a closing order, right? So no need to select the strike price because it'll be automatic, because it's a closing order will be exactly matched with your expiration date, with your strike price and all that. So they make it very simple in TD Ameritrade. You can just select that dot at the end of the line, and you can select the closing order. It will prompt you, and it won't execute immediately, right? So when you are doing the step, all these steps you do at the same time, right? Step 1, step 2, step 3, all these things you do at the same time. So 1 and 2 will probably get executed immediately, right? If you choose the correct price. But step 3 will not be executed. It will be a working order until later on, right? So you select a closing order for step 1 by spending 10%. So you will choose 20 cents, whatever is there, and then you at that price you will close that order, right? You will buy that put back. Whatever you have sold the put for $2, you will buy it back at 20 cents, which will close it.
So basically, you're saying you're happy with 1.7.
1.8, yeah.
No, because 1.8 minus the 10% again, so 1.7.
Where is the 10%?
For the step 3.
No, 10% of $2 is 20 cents.
Oh,
$2 minus 20 cents is $1.80.
yeah, that is step 2. And the step to closing order will be on 10% of the
10% of the original, right?
Okay. No, so okay. So earlier one was the step
You're
2
right.
insurance.
You're right. So in you are probably losing this, but we don't know. We don't know what will be the price of that, right? So this is just the closing order for step 1, and step 4 is the closing order for step 2. So that's why I got confused. Okay.
Okay.
So that means you got 90% of the $2, right? No need to select the strike price. When this happens, your obligation is over. You can sell one more put to collect additional cash at different strike price in the same contract period, or the next one. If it is just 1 or 2 days left, then you can select the next week. Actually, in this case, low wick strategy is next month, right? So you can select the same expiration date, same month expiration date, or the next month expiration date. So that is the closing order. And step 4 also there is a closing order, right? So closing order for step 2 by collecting 4 times the amount that you paid to buy a put. So, okay, in that our example, right? So $2 was the premium, X was 2. So 20% was 40 cents, right? And here closing order for step 2 by collecting 4 times. So 4 times of 40 cents is $1.60, right? Can anybody tell me when the put price will keep on increasing?
If the stock price keeps going down.
Yeah,
right?
exactly. And it's probably in the money, right? So closing order for step 2 by collecting 4 times the amount that you paid to buy a put. So this is an opportunity, right? So you paid this insurance 40 cents, but you are collecting $1.60, right? So you just close it out. But at the same time, if the market drops drastically, then you lose your insurance. So if this happens, step 4 happens, you have to be alerted and you have to buy a new insurance. So that is why actually the current guidance, I think it's not 4, it's much more like 16 or something, because they don't want you to lose your insurance too quickly. So this is where it becomes a bit tricky, right? So this strategy. So if you just mechanically put 4 times and don't think about it, then the market keeps on crashing and the put will this closing order will get executed and you lose your insurance. So that means you are pretty open. So you cannot limit your losses anymore. So that is why I have been wary of putting this closing order. I put it at a higher thing. I don't put it for 4 times because this is an opportunity. But why are you buying insurance, right? To give you a downward protection. And if you lose your insurance, you have to be careful and you have to buy a new insurance. You have to repeat your step 2 without step 1. So it becomes a bit complicated, and this is probably okay if this is what you're doing fully. But if if you don't have time and if you're in meetings or something and the market crashes and your closing order will execute and you lose your insurance, and that's it, right? So then you'll be liable for much more loss. You are in a big, just because you're in a meeting, right? So that is why this one I am a bit wary of this. All the other strategy looks very sound, but this one I'm still thinking about it.
So what dictates that?
Larry, you can still do a.
Sorry.
Now, I was just saying you can do typically, you can do a 16x, but then within the Ameritrade, there are alerts that you can set it up for 4x and 8x. So that actually helps you to proactively monitor the direction of that. So it won't close it, but you can technically set an alert at 4x and 8x.
I agree with all that. I'm just saying it is not a mechanical thing. So it needs some involvement. It needs some, thing. And because I once during Monday to Friday, I'm pretty busy in office meetings and all that. I don't want to be, keeping on looking at these stocks and stuff.
Sorry, just to understand, the 4x, 8x, 16x decision is not dependent on VIX, right? Is it dependent on VIX to a large extent?
Yeah, I think that is what they we don't know how they are arriving at 16x, 4x, 8x, right? This is their strategy.
Right.
They are
So I'm
saying
saying, is it proportional to the VIX?
Yeah. So that is how their guidance, Suresh. For the low VIX, they typically recommend 4x. For high VIX, they recommend 16x.
That makes sense.
Yeah.
And the other question I have is, you said that we all saw that it's like a go weekly for high VIX and go monthly for low VIX in general, right? So all the 4 steps, you're going with the cadence of either weekly or monthly, is it? I'm trying to understand that. How do they align, right? The VIX aligns with the 4 steps, or is it an ongoing decision? You know what I'm saying?
Yeah, you have to look at according to their strategy, you have to look at the current VIX and decide. If you decide right now, it is 18, right? So it is a low VIX. So you will sell monthly puts as per the strategy.
Right. Okay.
And then the high VIX is kind of a 6-step process.
Yeah,
because it kind of covers both ways.
I have my next slide.
Oh,
High
okay.
VIX.
Okay. Yeah. Okay.
So any more questions on this? Okay. So next slide is high wicks, right? So which is very similar to the low wick scenario, except that there are two more steps. So there are opportunities. So you're buying a call also here, right? So first step is the same. That is the cash secured put, sell a put to collect premium, right? And step 2 is also the same. Buy the insurance, put insurance by spending 20% of the dollars, right? So with step 1 and step 2 are same for low wicks and high wicks. High wicks means greater than 20, wicks is greater than 20. That means you are dealing with the weekly contracts here, right? So what they are saying is buy a call above the strike price of step 2 to collect additional cash in case market has a sudden move upwards, right? So only spend 10% of the X dollars on the ask side. Whatever strike price is available with $10 of the X, that's what you will choose. So in our example, $2 was the premium. So you buy a call for 20%, for 20 cents, which is the 10%, right? Wherever the strike price is on the upside, so it will be more than the current price, right? So you buy that, right? So that is what you are going to buy, right? So this is basically again going back to what I said, Govind's and Jorge's opportunity cost and all that. It gives you a opportunity even if the market goes up. And so this is the step 4 is same as the previous one, like I think the step 3 closing order. So basically in Nanban strategy, whatever transactions you do, you create a closing order automatically, right? So basically step 4, 5, 6 are the closing orders for step 1, 2, 3. So in high wicks, the main differences are, there are actually 3 differences. One is weekly compared to monthly in low wicks. And also here their strategy is choosing $5. I think they might change it also with the way SPY is going up, probably $6 as well, right? So choose $5 away from the market. Does anybody remember what is the formula for choosing the strike price in the low wick strategy?
1.5%.
Yeah, 1.5%. Very good, Jorge. So here instead of calculating 1.5%, it is they are just saying it's a weekly option, but choose $5. And the other change is there are 2 more steps. So buying a call and setting a closing order correspondingly. So this 1, 2, 4, 5 same as wicks, low wicks, and step 3 and step 6 are new. Right, so this, because the volatility is high, we don't know the market. There is a upside, the potential upside also, right? So that is what they're giving you a chance. But this means you are spending another 10% as well. The downside is you are spending another 10%. So this is the strategy, right? So I'll show you thinkers. This is one of the transactions. I put for QQQ, right? So this is how it will look in Thinkorswim. This is your position. I just cut the one option here. So today is 5th of April, right? So 9th of April, I bought this last week, right? So I bought basically -1. Minus means what? Put means what? Anybody?
Short, is it?
Yeah,
Sold a
sell. Yeah, you sold a put.
Yeah.
So you are a -1 of 9th April, which is the expiration date, and 312 is the strike price. right? That is what I sold. I sold a put for 312, right, on -1 few days back, and then I got $409, right? 4.09 times 100, I got $409, right? Because the market went up drastically, right? That put I sold is only like 0.205, right? So I did not put a closing order here, otherwise it might have got executed.
Okay.
Right? So yeah, if I had put a closing order, then as soon as it 90%, so as soon as it came to like 40 cents, it would have been executed. This obligation would have been closed. I did not put a closing order here. So today it went down by minus 0.39. Two reasons. One is the market went up. Another is it is too close to this Friday expiration, right? So because of that, it dropped 39 cents. So that means P&L day means how much money you made that day, right? So because it dropped 0.39 dollars, I made like $39 here, right? At the same time, I also put this was step 1, right? So this is what I bought. And then I chose 20% of $4, which is 80 cents, and bought, so that is +1, right? +1. I bought a put for 293, right? So I spent $81. I collected $409. I spent $81 in buying a put. But because the market went up, the current value is only 0.045, right? This is my insurance. So I basically lost 76.50 on that. But it's insurance, right? So insurance, you lose the put closing order only when it goes up. When it goes down, you just keep it because it is a cheaper insurance for you. You just keep it. Just today it went down by $4.50. But I also bought an opportunistic call using 10% of my proceeds. My 409, I put 10%. So I bought it at 42 and the call happened to be at 334, right? So I bought it and today's price is $1.94. So again, I did not put a closing order, right? So I should sell this soon, otherwise it will become worthless. That is the advantage of closing order, right? So it depends on the market. So because the market went up, so this has gone from 42 cents to $1.52. Hey, just today, right? Just today. So it has gone up by $1.52 because the market went up. So I bought it at 42. Currently it is worth $1.94. So I should soon sell it, otherwise the time decay will kick in and I will lose this call. Because on Friday, if I don't exercise it, then it's gone.
What is the current price for the QQQ?
Sorry?
Current price, the QQQ.
Yeah. Current price is 336, 335.
Nari?
Yeah, Vish.
Did you do a weekly one here or more than a week? When did you?
This I bought last week. It was more than a week, like 1.5 weeks.
Okay.
See, because last week was a short week with actually the options
Friday,
expired
right?
on Thursday because the market was closed on Good Friday. So I think I bought it for like 1.5 weeks or something like that. Right? So basically how much money I have made here, right? 409, right? So let us say that if I just don't exercise it, I just keep, I don't sell it, I don't close it, then I will keep the 409. I lost that 81 cents, right? $81, right? And here, if I exercise it, if I exercise the call tomorrow, I might have made another $150 or like 42, 1.94, so $150, right? So if I exercise it tomorrow, if I don't keep it too long, then I make $400 minus $80 plus $150. So like $470, right?
Yeah, like
So
480 total.
yeah, so that would have been my cash income out of this transaction
Without owning the asset.
without anything. Yeah, with I just have the reserved the cash. That is the only thing.
Right. Okay. Cool.
Yeah. So what do you guys think about this strategy?
Looking good. You had to have $30-some thousand available, right?
Yeah. So this is a QQQ. So I should have like because I bought 312, right? So that is what I was committed. So I have to have in my bank 312 times 100, 312,000. Sorry, $31,200. Right? That is what I have to have in the bank. Whatever is the exercise price for the put option times 100, that's what you need in the bank.
Right.
Nari,
Yeah.
do you remember what was the price of QQQ last Thursday when you went into this contract?
I think if I used that same thing like $5 or something, right?
Okay. Then would have been 317 or something
It's
like that.
317. Yeah.
Okay.
Yeah. Any other questions? So wow, it has taken hour and a half. Any other
Good job.
questions?
Good job, Nari.
Oh, thank you. Any
Good
other
job, Nari.
questions?
Thank you.
Yeah.
Thanks, Mari.
Okay. Thanks.
Now
Thanks for
time to
joining,
practice. Now time to practice.
everyone. Yeah.
So Nari,
So
I have a question.
yeah.
This is Anupam. So Nari, what do you think? Like, where should we? So again, I'm beginner. So where should I apply this strategy? In which